Hi, this is Todd Ballinger, and on the wire today we have Dan Williams, and I've asked Dan to join me on a call because we've had a number of new users asking about how to set up, say, an FHA or maybe even an FHA versus a conventional on a new purchase using the software. So I know Dan does a lot of FHA and VA type work. We thought we'd have him join me on a little mock-up case study. And I got to thank you, Dan, because I understand you just had knee surgery yesterday. Is that right?
Yep, I sure did.
And fresh back in the office, and while you were out for a day or two, and just during a 2-day period, you got over 7 referrals from 2 financial advisors. Is that right?
Yeah, it really's been a good couple of days, an interesting couple of days with the surgeries. But yeah, the work and laying the foundation with the financial advisors and building relationships with them has really paid off.
That's fantastic. You know, we're big fans of that. We keep encouraging people to go out and build those relationships, especially right now. But let's take a minute. We aren't here to talk about financial advisors because we'd be off on a tangent. And I've set up this simple case: FHA, Mr. and Mrs. FHA homebuyer. And let me just kind of lay out the case here for those of you who, if you're watching this now, you may have asked the question, or you may be in our case study series. We've got a $200,000 contract purchase price. And on the details here, I've just put in the client has $10,000 saved up to put down a 5% down payment. So they could do this theoretically, I guess, with a purchase of a conventional or FHA. They've got $89,000 annual income. They're in a 30% tax bracket. They're currently renting with a landlord at $1,000 a month. So the real question is here, can they buy a house around that $200,000 range with 5% down? And then the second question is, how would we set this up in the software? So I'm going to go over to the Borrow tab. You can see that brings up our current liabilities, which is just that $1,000 a month rent payment. And the first column here, and I'm going to have kind of Dan just talk through, and I'm going to enter this in as we go, but we've got an FHA 30-year fix. So Dan, if you had a contract price of $200,000, I assume you'd select a 30-year fix for the product type. And then what would you use for the LTV?
Well, I would leave the LTV alone, and I would enter in the loan. Leaving it at 5% is fine, but it'll go back and recalculate once we add in the upfront mortgage insurance premium. So let's just leave it at 95% for right now.
Sounds great. So that gives us a loan amount of $190, and interest rate today. What would you typically be putting in today?
Yeah, we could be doing it 4.25 even.
All right, so let's throw in 4.25. And I know we need to go in and edit our payment structure here. So we've got property taxes at 1.25 and homeowners insurance. And how would you set up the mortgage insurance typically for your FHA loan?
Well, the mortgage insurance, you got the property insurance, the mortgage insurance, with less than, I forget what the recent change has been. I think you have to put down more than 10%. So in this case, you're looking at 1.15% for mortgage insurance.
And that's on a monthly basis?
Yes.
So we put in, oops, that'd be a little high there. So we're going to put in 1.15, and that's going to calculate about $182 a month in mortgage insurance. Mm-hmm. And that would stop with the FHA phase out. You do a number of payments or LTV typically?
I just like to quote it a number of payments, which is 5 years or 60 months.
Great. So that's going to phase out after 60 months. So by setting this up, you've got $182 a month. It's going to be tax deductible. You got to phase out after 60 months, and that's all you really have to do to set up the monthly. Correct?
That's correct.
So we hit the save button there, and let's say we'll go down for 1 second on that one before we look at say the conventional alternatives and look at the closing cost structure. So would you be financing in any closing costs or fees for this particular borrowed in typically?
Yeah, what we definitely would finance in would be 1% of the loan amount, which is required for FHA.
Okay. So you would then take $2,000 and put that right here?
Take $1,900 since it would be based on the loan amount.
Yep. $1,900. And then would you add that into the loan amount from there?
Yes.
So we click the add to loan. That's going to add that $1,900 in. You'll notice the loan amount now is $191.9. I can see it here, and I can go up and double check. That gives us the 191.9, and we're now at 96% LTV. Great. And then traditionally, you put in whatever your origination fees. In your market, are you typically doing a one origination?
1.5.
1.5. All right. So you get 1.5 on the origination. Any discount points or other closing costs?
You're going to have closing costs of about $3,000 on a loan this size.
And that's just going to be the generic closing cost. Now, sometimes people ask about, upfront fees. Are there any special additional fees with an FHA loan like this?
Nope. We just got the upfront mortgage insurance premium, which we already accounted for.
And that's in the $3,000 here.
That's in the $1,900.
Oh, I got you. So that's the 1% fee. That's the MIP fee that you're financing in as the 1% there.
Right.
Great. So we've got $5,878 now in closing. We've got $1,900, which we're rolling into the loan amount. You've got your standard origination fee and your closing costs. That gives you closing costs of $5,878. You got a down payment of $10,000 plus the closing cost prepaids that you're going to need minus the $1,900 that you've rolled in. So you're going to need $13,978 cash to close. The client has $10,000, so this is letting us know they'll need to come up with about another $39,778 to make this work.
And Todd, you did not put anything in there for prepaids.
I did not. Would you typically put something in there for prepaids?
With FHA and the other scenario as well, we're required to have those.
Okay, great. So what would you put in there, Dan?
In this case, let's just put $2,500.
All right, so we got $2,500 on the prepaids. And you would do the same if we were doing this as a conventional. Well, we'll come back and do that in a second. So now that lets us know they're going to need another $6,478 to make this work, right?
Right. So we're going to have to get with the realtor in this case and say, hey, what kind of seller's credits can you get for us? And then we're going to have to work in some rebate as well.
So if you could in the situation get a seller to say pay $3,000 in closing costs, would you typically put that here?
Yeah, and in our market, we're seeing a lot of 3%.
A lot of 3%.
Yeah.
So I can put in 3% there. That's going to give you $5,757 as a seller credit coming in, and now you've got that client real close, right? They can get in for about $721.
That's right.
Awesome. I like it. Anything else you would do in setting up your closing costs?
Nope. That's pretty straightforward, pretty simple, and it works great.
All right. Well, let's compare that to say a conventional. So, tell you what I'll do. I'll just sort of expand alternative 2. I'll call this conventional 30-year fixed, and I'll just click the duplicate button to bring everything down. Now, everything's come down from the above area. What would you do differently now, Dan, in terms of setting up the conventional? Would the interest rate be the same? Would it be a little bit higher?
Yeah, it would be very, very similar. So just keep it simple. I like to show people if they're really exploring these two options. Let's keep the interest rate the same, and maybe we make an adjustment to the lender credit or not. But let's, as much as possible, do an apples to apples. Okay,
and then would your LTV be back at 95 for that?
Yep.
All right, so we're going to take that back to 95%. And then under your payment options, you've got taxes and homeowners insurance are the same. Your mortgage insurance is probably going to be lower, though, isn't it?
Yeah, typically it's a little bit lower, depending on FICO scores and some other factors, but you can put in 0.75%.
All right, great. And then with that, would you typically do more like a 78% phase out?
Yep.
So the big difference, folks, is on a conventional loan like this, you're going to have probably a little bit lower monthly mortgage insurance payment, and you're going to be looking at, instead of phasing out in 60 payments, whenever you hit that 78% LTV is your best shot on the phase out there. So I hit save, and you can see the only difference here is we've got a 95% LTV, same interest rate, and we're going to have a little bit different MI payment incorporated into this. And when you go down now and you look at your conventional, we've got nothing financed in on the actual closing cost, so we can see our loan amount's really $190. And then would you tend to be charging the same in terms of origination fees?
Yes.
And closing costs you'd expect to be the same. The prepaids would be the same. And then lender seller credit, same 3% target there.
Yep.
You can still get that for a conventional buyer. So looks like the big difference here is that client's going to have to come to the closing cost or come to the closing table with about $2,650, because you aren't able to finance in those additional costs related to the buying transaction. Anything else that's different here that stands out to you?
No. No.
So a big benefit of FHA is you've got a little bit more in terms of upfront cost and stuff, but you're going to be able to come to the closing table or be required on the conventional loan to come to the closing table with a little bit more out of pocket.
Yep. Yeah,
right.
Absolutely. I mean, they're normally relatively similar, and I've found that there's other reasons that are pushing people towards FHA or conventional.
And you said that's usually things like a credit or co-borrower type transactions or situations, things like that?
Yeah, the biggest one is non-occupant co-borrower as well as debt-to-income ratio. FHA is a lot more forgiving than conventional.
That's great. So you may have to do it for qualifying purposes. And if we went on down and looked at the payment differences, we can see there's a slight payment difference. If I even look at it on an after-tax basis, I'm going to be paying a little bit more here, $71 more than I'm paying in rent today versus $20. So I've got about a $50 difference here on the monthly. But they're going to phase out a little bit differently, the FHA over 60 months, whereas the conventional would be more like at that 78% LTV. So it may or may not make a big difference, but I can see here in both situations I'm better off renting. The FHA is going to save me about $57,000 versus renting. Buying the house, $58,000 with the conventional over 7 years. And I can see slight nuances if I drag it out 10 years. But like you said, not a big difference in the net cost structure. It's really going to come down to what the client is able to qualify for. But if they want to see a conventional side-by-side, here you're able to show them that difference and look at the cost over different time frames. So maybe $1,000 difference over 3 years short term, but you get out over 10 years. Not much of a difference at all. You're talking about $100 difference over 10 years.
And, you know, we also do the same thing with VA. On the upfront mortgage insurance premium, the VA calls it their funding fee. And you could put it in that same spot up top where we added it to the loan. You can incorporate that into the amount you're financing with a VA loan.
Well, let's do that real quick. So let's just say VA 30 year fixed, and in that situation you're going to be able to do what LTV?
You can go to 100%.
So I can go all the way up to 100 here on my loan amount, and interest rate would be about the same?
Yeah, they're very, very similar.
And then over here on the payment itself, the difference here, would I still be at that same kind of that 1.15?
There is no mortgage insurance with VA.
Wow.
That's what makes it a wonderful, wonderful program. 100% financing with no monthly mortgage insurance. And the other thing to keep in mind for folks that aren't experienced with VA, if your client has a VA disability rating, there's no funding fee. So it truly, we do quite a few what are called VA no-nos. No cost, no fees, no down payment.
Wow. So if your client's able to qualify for a VA, then we'll show here that that's probably a phenomenal financial deal for them. They get 100% financing, the low rate without any of that MI.
That's right.
And so
That's right.
You have no financed fees to worry about then, and you can still charge your normal 1.5% fee.
Yep, under the lender paid model. Yeah, absolutely.
And then your closing costs would still be about the same, around $3,000, right?
Yep.
You'd have your normal.
And the VA, you can also get up to 4% seller concessions.
Wow. So if you could get 4% from a seller. So, wow, that's pretty exciting. So, if the client had $10,000 cash available in this situation, they could walk away from the closing table with almost $9,500 of it?
Yeah, I mean, we have literally done transactions where the client has had their earnest money deposit refunded.
At the closing table. Wow.
Yep.
That's pretty exciting. And obviously, when you come down and look at the payment side by side, you can see that you've gone from negative 71 comparing to on the current rental. And remember, folks, you can always, if you don't want to compare against the baseline current liabilities, just shrink that up. And now I can compare the loans side by side. And so I can see the difference here. I got coming to closing table with an extra 721, an extra 2650, or walking away with 9,500 of my available cash. and then comparing the payments. The FHA 30-year fixed, here's my baseline at 1071, 51 less for the conventional and 95 less for the VA. And I come down over 7 years, and I've got my baseline FHA. I'm saving about $989 on the conventional, but saving over $8,100 on the VA over that same time period. So for those of you that do VA, and Dan, USDA has come up a few times. Is that very similar to the FHA, or would you say it's more similar to a VA type loan?
I look at it more similar to FHA, and I have very little experience in that market because, I live in a major city, although we do have pockets that are considered rural. But I live in such a heavy military part of the country that we do VA every month. We are doing VA transactions all the time.
That is wonderful. So if you've got somebody that can qualify for the VA, this is a clear winner. But this is great because this shows you how to set up an FHA compared to a conventional and a VA, and how you can do it in a clear way to show the client the closing costs, help them compare that monthly payment difference, and ultimately see financially. Obviously, if I can't qualify for a VA because I'm not a VA customer, then I can shrink that up, take it away, and just compare that FHA versus the conventional. And again, show the client, hey, this is you're not out a lot of money going FHA versus conventional, $1,000 over 7 years. So it's not like you're really losing out here, and you got a chance to get them in the home possibly because they can qualify FHA. That's phenomenal, Dan. That's a big help. Any other little tips that you would give a new user?
To a new user, just use it. And it's amazing how simple it is and how straightforward it is. And it truly brings clarity. And my experience has shown me that when folks have this clarity, they have 2 choices or 3 choices max, and you show them the numbers, it's amazing how much easier that decision gets to say, okay, I'm going to go forward with this transaction. So, kudos to you and your folks. This is, it's a game changer.
Thanks, buddy. And congratulations again on your success here with the financial advisors. I think you said when we got on the call, you just gotten one more in this afternoon to make it 8 referrals in 2 days, huh?
Yep.
That's
and pretty big loan sizes, yeah. So very, very good stuff. So
awesome, buddy.
Yep.
Thanks for your help, my man.
All right. Take care.
Talk to you soon.